Hello there everyone, today's video is all about the consequences of the proposed tax cut made by the Chancellor in last week's spring statement, specifically how it impacts on your pension pot. So a lot of the issues that were announced last week in the spring statement, which was very light on content really, were to do with not a reversal of the announced national insurance hike, but the delay which NI kicks in and a few other things. But then right at the end, the almost rabbit out of the hat moment where the Chancellor said, oh, and we intend to reduce income tax, but we'll do it by the end of the Parliament. So it's an aspiration. So in other words, politically speaking, he's saying, look, we're going to have a tough couple of years, but then we're going to make things a lot better right before the general election, and we're going to knock a penny off the income tax rate. Okay, great. So if they do that, fine. But what are the tax consequences for your pension? Well, let's just have a look at this. So assume you've got a guy who's on a salary of 50 grand. So he's on £50,000. How is he taxed? Well, he's taxed 12,570 at nil, which is the personal allowance that everyone gets. Then the balance up to 50 grand is at 20%, £7,486. So ignoring national insurance for the moment, just the income tax, he pays 7,486 on 50 grand salary. Now then, he also puts in, let's assume, £3,000 per annum into a personal pension, into a SIP. So he puts that in. And what does that do? Well, it doesn't knock anything off this income tax bill because he's a basic rate taxpayer. But what it does do, he does get basic rate tax relief, but it's all to do with how much gets in the pension pot. So remember, the mechanism for getting tax relief on pensions is twofold. If you are a basic rate taxpayer, you basically get an extra amount credited to your pension fund by the government. And if you're a high rate taxpayer, you get the first thing, like with the basic rate taxpayer, i.e. an extra amount credited, but then you also get some extra relief via your tax return to reduce your tax bill. So high rate taxpayer, 2 bites at the tax relief cherry. Basic rate taxpayer, just 1. But the basic rate taxpayer won't see that benefit in terms of reducing their tax bill. They'll see it by having more in their pension pots. And if they look at the statement or they go online, they'll see that the government top up their pensions. So that's how the mechanics work. So let's just follow this example through to the point at which Rishi Sunak has promised us this 1p tax cut coming in 2024. Okay, so fast forward a couple of years, same guy, he's on 50 grand a year, but this time he's going to pay less income tax because we've got 19% basic rate of income tax and not 20%. Again, crunching the numbers. Now, we already know that the personal allowance is going to be frozen. I've done separate videos on fiscal drag and what all that means. But for the purposes of this, just looking at the pension implications, 12,570 personal allowance, same in 2024 as it is now. He's on 50 grand. The difference, 37,430. Now it's taxed at 19% instead of 20%. So, tax bill on that, 7,112. So on the same salary, 2 years hence, he's going to pay income tax 7,112, whereas right now, you pay 7,486. £374 better off from an income tax point of view. Ignore national insurance calculations for now, but just purely on income tax, that 1 penny drop from 20% to 19% for someone on 50 grand is going to save them 374 quid a year in income tax. Great. Okay, but what is it going to do to their pension? So, remember I just said that the mechanics of the tax relief on the pension, it's a kind of a bit of a misnomer really where you talk about the tax relief because like for the basic rate bit, it's not really tax relief. It's added extra amounts to your pot, although it's labelled as tax relief because you're getting something from the government. HMRC top it up. That's why they call it tax relief. But it's not reducing your tax bill if you're just a basic rate taxpayer, but you are getting something for nothing, for want of a better phrase. You're getting more money being put into your pension fund than you yourself have contributed. Hence, it gets lumped into this tax relief. So how exactly is it affected? £3,000 goes in. So we're coming back now to right now. £3,000, it's what we call grossed up. So the gross amount of that pension is 3,750. In other words, the individual puts in 3,000 and the government put in 750. So 750 being 20% of 3,750, and the individual puts in 80%. So you can see how the government put in 20%, individual puts in 80% of the gross amount. So the bit that you put in is 80% of the total. The government top it up. So that doesn't reduce your tax bill. It just means you've got more in your pension pot, but it's still called tax relief. So what happens in 2 years' time when we have this reduction in the income tax rate? Well, same calculations, you've got to gross up, but the fraction changes because now we're going from 20% tax to 19% tax. So you gross that up, 100 over 81, i.e. 100 minus 19% tax, equals 3,704. So the gross pension, 3,704, whereas before, 3,750. So the government top up your pension pot by 704. In other words, £46 less. So it's not unintended consequences, it's all thought through, but one of the consequences of a reduction in the basic rate of income tax is that yes, you're going to save 300 and something pounds in actual income tax, but less is going into your pension, which is never a good thing. If you're saving for the future, generally we're not saving enough as a nation. I mean, there's millions of people will not have enough in retirement. The state pension cannot sustain a reasonable income. So it's so important to maintain pension pots and put in as much as you can. So that drop in income tax doesn't actually help. It may seem counterintuitive. Yes, you're better off in terms of you saving money by paying less tax, but on the flip side, less will be credited into your pension, topped up by the government, by virtue of the fact that the income tax rate, the basic rate, has gone from 20 to 19. So less is going into your pension pot going forward. So the tip is, the takeaway from this video is, for goodness sake, use some of this tax saving that you're better off by to put more in your pension, basically. So in this example, this guy's going to be just shy of 400 quid better off, but he's having £46 less into his pension pot. So it's simple. Some of this tax savings needs to be reinvested. It's got to be reinvested to maintain the status quo and the investment growth status of that pension pot. So please don't ignore this and think, great, I've got an extra 400 quid in my back pocket here to spend on whatever. You've got to get some of it back into the pension, because you're going to lose out by not having as much credit from the government to top up your pension pot by virtue of the fact the income tax rate has gone down. So income tax rate going down, great because you're paying less tax, not so great because you're getting less credited to your pension. But hey, listen, it's simple maths. Look, one outweighs the other. So the income tax saving of, you only need to put in a fraction of that to get yourself back to where you were. So overall, you're better off. But why ignore this? Don't blow this, for goodness sake. Get some of this back into this to maintain that pension pot. Now, just a word on higher rate taxpayers. So what if Mr. X here was on 100 grand or whatever, in the 40% bracket, which kicks in not much above 50 grand. So the Chancellor hasn't announced any reduction to the 40% rate. As far as we know, that's still going to be 40%. That's not going down to 39%. The proposed income tax reduction is only in the basic rate band. So for a 40% taxpayer, there is no change. In other words, they're still going to get the two-pronged mechanism, relief, being 19% credited to their pot, but 21% comes off their tax return. So they will see actual tax savings. It'll come off their tax return. 21% will be the saving that they get, because it'll delay the point at which the 19% turns into 40%. So actually for higher rate taxpayers, overall it's a better deal. But in terms of the pension thing, pension relief, but similar in a way that less will go into their pot from the government. So again, with high rate taxpayers, they're going to see a saving of that reduction in the basic rate, while still having maximum tax relief on the pension contributions, but 19% will hit the pot, similar to with a basic rate. So again, the tip is for higher rate taxpayers, some of that savings, get it reinvested in the pension pot to maintain those levels of contributions that would have been there. The gross contributions. In other words, the sum of what you put in plus what the government tops up. If the government top up is less, you've got to put in more to get the status quo. So just an overview there on something to think about with proposed tax savings. Yes, it's great news when that does happen. First time in 16 years, by the way, if that promise is honoured by the government. That's great. Listen, tax savings always a good thing, but think about this: less going into your pension pot unless you do something about it and move some of the money from your income tax savings to put more into your pension. So if you like this video, please do subscribe, and I'll see you soon.